Hello, everybody. Steven Sitkowski here. Welcome to this week's edition of Market Insights. It is March 17th. Hope you are well. The market for the last couple of days has definitely been better behaved. And I think a lot of that is, very candidly, that we haven't got any big announcement of tariffs or trade wars. So it's allowed things, at least for the time being, this is subject to change, kind of chill a little bit. So happy for that. Let me share my screen with all of you. There you go. Had a fabulous day of skiing today. We've had a lot of late season snow, and it makes even an amateur ski like a professional. Quick reminder that everything we do here is for educational purposes only, not intended as investment advice. So what's moving the markets? We're riding a 2-day win streak. Woohoo! So, you know, we're not far off of where we started at the beginning of the year. I know it feels like, the markets have dropped 20%. That's not what has occurred, but I'm hoping that this week helps to kind of right the ship. And there are some variables that we'll talk about that'll determine that. Retail sales up 0.2% for February. Hopefully that'll quell some of the inflation conversation, or excuse me, recession conversation. You don't have a recession when you have an increase in spending. You have a recession when people stop spending. Next Fed announcement is due out on Wednesday. The announcement is perfunctory, but the comments will be really interesting. I feel like the comments should be favorable, giving the CPI print and the PPI print that we've had the last couple of weeks. Both of those, I think, were highly encouraging. 10 years come down a little bit, back below 4.3. And oil prices, Trump made a comment regarding Iran, hence oil prices ticked up a little bit. Not dramatic, but at 67.48, it was in the 65s. What to watch this week? Here we go. So these were the retail sales numbers right here. Retail minus auto. So both of those were solid. Compare them to last month when retail sales were negative. So that's a good thing. New York manufacturing survey, that is discouraging. The manufacturing numbers have been picking up. I'm not sure what happened, but that's just for one region, but that's not great. On Tuesday, nothing that's really going to move the markets. Wednesday, it's all about the Fed, so you want to be tuned into that. Thursday, we get initial jobless claims forecasted at 225,000. Again, it's kind of nice to see what the health of the labor market is. And we're expecting the Philadelphia manufacturing survey to fall from last month. Existing home sales, we're expecting those to drop a little bit, and leading economic indicators to fall a bit. So kind of a mixed bag, nothing coming out on Friday, but the Fed, I think, will be the most important participant to how the market reacts and responds. Here's last week's heat map. Big winner, NVIDIA. I always tell people, you see NVIDIA pull back, boom, get more. I can tell I just did 10 more short puts on NVIDIA literally this morning, which would obligate me to buy an additional 1,000 shares. and I did those at 115. That's the strike price. So, if they want to sell me more NVIDIA at 115, I'll take it. Now, if you're going to utilize a strategy like that, obviously you've got to have the money in your account to be able to make the purchase. But and for doing that, and I'm only committed between now and Friday, $1,650 instantly deposited in my account. Did that before I went skiing. So, Broadcom, nice. Micron, really good week, up 18%. Tesla had a good week. Netflix had a good week. So, as bad as things felt last week, looks to me like a pretty good balance between winners and losers. For the last year, of course, much more bullish. Maybe the most remarkable thing is that, NVIDIA is now only up 31%. I'm so accustomed to seeing that 1 year number, between 100 and 200%. It's definitely come back down to earth. There's no question about it. Market sentiment continues to be bearish. I get it. Maybe one or two more solid weeks, this changes. But according to the independent investors, 59.2 expected the market to go low over the next 6 months, and only 19.1 expected to go higher. And I'm telling you, in my opinion, the 19.1 are going to be right, and the 59% are going to be wrong. And the fact that they think it's going to go lower tells me they've probably sold their positions. There's part of the reason that it went lower, and they're going to miss the next opportunity. How much of the Fed going to raise or cut rates? Here's the latest and greatest. So we're expecting no rate cut to be announced on the 19th. There's an 80% probability as of this moment, no rate cut in May. There's about a 68% chance that we get a rate cut in June. So we're looking for a rate cut in June, a rate cut in September, and then nothing else for the rest of the year, which is a change. We were looking for a rate cut last week in December. Now they're not showing a rate cut. And again, this is dynamic. It changes with the data. They're not showing a rate cut until March of next year. So nothing in December. 1 year sector returns. Here we go. So for the last year, the S&P is up 10.91%. Doesn't sound like a crash to me. How about you? And the big winners, utilities, that's the power to fuel the new data centers. Communications has done well. Financials, done well. Tech, kind of a push. Consumer staples, kind of a push. Same with discretionary and industrials and REITs. And then we really fall off with healthcare, energy, and materials. But, materials is the worst performing for last year. It's down 4.33%. It's nothing. How about, let me change this to year to date. How do things sit? So the S&P is down year to date 3.51%. Is that a big deal? Not exactly. Healthcare, energy, utilities, REITs. Well, actually, the only three that have beat are utilities, energy, and healthcare. The big loser has been consumer discretionary and technology. See, they were the big winners. And then when we got into kind of a risk-off environment, we saw rotation out of those and into the stocks that candidly looked cheap. So that's what's been going on. Let's take a look at our chart. Hang in here. Let me log in for you. And the chart still isn't fantastic. It's just better than it was. So here's the S&P 500. So you got kind of this V-shaped recovery that we are attempting, okay? But we are still below the 50-day moving average. We still see that 50-day is sloping downward. So we're cautious. Right now, what we're dealing with a news-driven market. Um, with that news being the news coming out of Washington, D.C., and the battles that we're picking, with these other countries. So to the extent that we don't get a bunch of that new news, the markets move up. First time we start, appearing that we're going in for trade wars, market moves down. Now, long term, might these trade wars be a good thing for the US? We'll just have to see. I'm not going to make a judgment. What I do know, markets like certainty, they don't like a lot of chatter coming out of DC, and hopefully we don't get that. Hopefully we get kind of a benign report from the Fed. And if those two things happen, I think we ought to be in pretty good shape, but we will watch. That's all we can do. All right, gang. Well, I will be seeing you shortly. And until then, be blessed. Bye.